If you can catch some of the stocks that have been punished because of tariffs, these stocks are inevitably going to recover.
Too soon to get back in, or the perfect time to buy before these stocks fully recover?
And I think that the volumes are going to come right back.
MarketBeat's Gabriel Ossorio-Mazzili makes a case for 5 stocks that have been beat down by tariffs that could offer a huge opportunity for investors.
This stock could offer you 100% plus upside.
With plenty of tariff uncertainty still ahead, will the risk be worth the potential reward for you? Let's dive in. Gabriel, glad to have you back on the channel to talk about this roller coaster month that basically any stock related to tariffs has had, and that's a whole lot of them. But you have a list for us today of 5 companies that the tariff situation might be resolved enough for investors to buy in now. We'll get to your list in a minute, but I want to just have you give a brief overview of the tariff situation. Where does everything stand right now?
Well, it stands a lot better than it did a couple of weeks ago, right? The Chinese retaliation is starting to make a lot more sense, and that gives the playground, or the battlefield, I should say, a little more definition as far as the outcomes or potential outcomes that could be had in the stock market and the global economy. So now that the US has defined more of the items and products that want to be tariffed outside of China and other Asian regions, now we're approaching the final phase of negotiations, of pulling back and forth, of creating volatility in the stock market. And you can see it so far this week. The S&P 500 seems to have consolidated a little bit. Further news and further headlines have come out this week as far as President Trump removing tariffs from automakers and auto parts, creating some exemptions for semiconductors, consumer electronics, and whatnot. And then China has hit the US with a ban on Boeing airplanes and other products as well. Yet the S&P 500 didn't really react. So I think that the market is now exhausted for the whipsaws that have been coming in through headlines. Now the next step would be a resolution, one should hope. So let's see how the S&P reacts when and if China and the US can come to an agreement, hopefully soon.
I think before we get to this list, it's important to talk about there is still risk involved with any stock having to do with tariffs because of the unpredictable nature of those headlines that could still come out, the announcements that could still come out. As you said, things are still kind of settling out, but thankfully the market is reacting less. Before we get to your stock list, any warnings you want to give investors about what to think about before getting into these stocks?
Well, first of all, you have to think of the fundamentals, right? So how exposed are these companies to a potential new announcement of tariffs? How exposed is the supply chain, the raw material chain, or the IP security if you're talking about a technology business, right? However much exposed they are to tariff and certain blockades of China versus the US, I think that revenues and earnings could be severely affected. So if you could mitigate your exposure to some of these factors, I think you'll do well. But also on the flip side, if you can catch some of the stocks that have been punished because of tariffs, then inevitably this is going to resolve, right? And these stocks are, again, inevitably going to recover, unless you think that tariff and trade deals are going to wipe out the biggest brands and the biggest companies in the US and in the global economy.
Yeah, that's a great point too. And for investors who like a little risk, let's get to this list. What's the first stock that you think investors could consider now that the tariff situation is starting to resolve?
Well, that would be XPO Logistics, right? So the main thesis behind this stock is that uncertainty about GDP growth, economic activity, and volumes of trade have sent this stock down to less than 70% of its 52-week high. I would consider that a discount for a couple of reasons. One, there isn't going to be a complete stop of trade and transport within the US. Whether there are tariffs or whether there aren't tariffs, I think that domestic business still has to go on. People still have to consume defensive and cyclical products as well, no matter what's going on outside of the US. Now, of course, if you have less trade happening with other countries, you might see a slowdown in logistics, and transportation and all those other areas. But again, I think that at today's price and at today's discount, XPO looks like an asymmetric risk to reward setup if you believe that these conflicts are going to be resolved in the coming weeks. So I think that when you look forward in the following 1 to 3 months, XPO makes a lot of sense today.
For those who don't know, who are not familiar with this company, share a little bit more about what XPO does specifically and how tariffs may or may not impact it.
Well, this one focuses more on less than truckload shipments and parcels within the United States. So anything that's business and personal related, as well as some small business consumption, is going to be affected as far as demand volumes for XPO. So again, most of these products have very little, if anything, to do with international trade unless you're shipping stuff from China, unless you're shipping stuff from the European Union, and then those parcels need to be uh, carried out logistically through XPO's network. So again, there is some risk to this stock, but I think that it is subsiding. And again, you could weigh out the risk versus the reward at today's price. And I would say that below 70% of its 52-week high, most of the downside has already been baked into the stock. So that leaves you with a lot of potential upside with very little downside risk.
All right, let's move on to the second company on your list.
Well, that would be a very unconventional and unpopular name today, and that is Alibaba. It was popular, it was kind of famous and red hot about 6 months ago when Michael Burry and David Tepper announced that Alibaba was their respectively biggest holding in their funds. Now, everybody started buying, everybody got excited about the stimulus that China was rolling out in its economy. The stock went from just over $80 a share to over $130 a share, and analysts were expecting it to reach 180, even $200 a share. Then tariffs happened, and now all of a sudden, Alibaba is not the business that everybody thought it was. The only thing is that it still is. Alibaba is not only exposed to e-commerce, right? It's not only exposed to shipping and within the Asian region, within Europe, and within Latin America, and some American consumers as well. It is also exposed to the data center business across all of these fast growing middle classes, collecting data left and right. So if you think Amazon pulls data from consumers across the United States and across all the markets that it operates under. Alibaba does the same thing, just doing it over a broader market, bigger market with faster growing middle classes. Not only that, they have a cloud computing business that is also exposing the company to AI trends. So I think that, sure, they're going to take a big hit from trade tariffs if it affects the commerce business. But again, they could hedge it out or they could mitigate some of the impacts by growing their technology branch. So I think that Alibaba, again, at today's price, could be a no-brainer with some risk, but when you weigh out the potential profit upside and the potential risk, it starts to look a bit more asymmetrical moving forward.
You mentioned a lot of the moves that this stock had starting about 6 months ago. Let's look at the chart right now for Alibaba. Where is it trading at today? And where was it even before that spike 6 months ago? With such a volatile play, is it just because it's the early stages of this company? Or why are we seeing so much volatility even before the tariff situation happened?
Well, remember that the trade tariffs started in 2018 and they subsided as we changed administration for the president in the United States. And then Alibaba sort of hit an all-time high. Well, not sort of, it did hit an all-time high around 2021, just over $310 a share. Now, that is around the time where people started to look into China as a potential long-term tailwind of an economy for growth, for really expansion on earnings that drives stock valuations, right? In fact, Charlie Munger, Warren Buffett's former right-hand partner, started buying Alibaba around $250 a share. So he thought it was cheap then. Now, after that, the stock spent about 2 years around the $68 to $75 a share range. It would break above to 85, 85 and change, and then come right back down. And it just spent 2 years there. What didn't spend 2 years in the flat line was the company's free cash flow, revenues, earnings, and market share. All of those factors expanded during that time and brought Alibaba to a leading position in the industry, not only for e-commerce, but also for data centers, for cloud computing, and much more. So now, I think that with the advent of Michael Burry and David Tepper announcing their investments, I think the market started to feel a bit more confident, as if saying, well, these two guys trust the numbers out of China, so I will too. And then demand started to come in for Alibaba, and then you started to see the upswing, which again, it's only a fraction of these stocks all-time high, and almost half of where Charlie Munger thought it was cheap again. So I think that once the fear of China and the fear of retaliation and a potential economic all-out war subside, then I think that Alibaba is going to be the top pick once again.
An interesting and controversial pick, especially during this time of tariffs. Your next pick, kind of a similar story. Let's move on to your third stock pick.
Yeah, so that would be Pinduoduo or PDD Holdings, right? They own the store that we all know and love, Temu, which is the cheaper version of Amazon and an even cheaper version of Alibaba. Now, there's a specific play that comes into PDD moving forward, and that is the fact that President Trump exempted Chinese parcels that are worth $800 or less from being tariffed, right? So that is where Pinduoduo or PDD reigns king, right? Because Alibaba is focused more on wholesale, on volume, so they might be exposed a little bit to the tariffs on these parcels that are $800 or more. Now, PDD is completely out of the woods, I would say, for the trade tariffs that are coming in and out of China, right? Which is why the company is not only a bit smaller in market cap, even though it is 120 billion and change, it also carries a lot more upside in the face of analysts, in the face of the market as well. And it carries a significant discount, trading close to 60% of its 52-week high. Now, this stock could offer you 100% plus upside. Why? Because the underlying revenues have been growing at double digits for the past 2 years. At one point, in fact, the market cap was even bigger than Alibaba's. I think it was around 2023, 2024. It was a big headline because it's such a small company, because of its fast growth, managed to be bigger than one of the Chinese blue chips today. So I think that, again, with the introduction of tariffs and the introduction of fear and uncertainty, a company that was once the darling of China is now being punished for political reasons. And I think that once those subside and the certainty comes back into the market, we're going to see that stock fly again close to 52-week highs, if not making new ceilings once more.
I think this is a really interesting point that now, because of the small parcels exemption, that Temu really wouldn't be impacted as much. And I think that that's something maybe investors aren't thinking about. You think about products coming from China, you instantly think tariffs, but you're saying pretty much all of this company's business will be exempt from any of the current tariffs we have. Could that change?
I think it could change if President Trump pulls back on the exemption, right? But I think that there's a strategic nuance to why specifically $800 or less. I think that he understands that most of the consumer activity is around those levels, those valuations, right, for products and spending budgets. And again, this is where PDD shines. And I think that the volumes are going to come right back. I think that the scalability and the market penetration is just too much for it to just be put to the side. I think it would have an impact on inflation. If we remove the low cost alternative, I think it would have a severe impact on the way that people spend money today and the way they budget for the expenses. So economically, consumer wise, I don't think it makes sense to mess with success, right? And people love the products, people like the quality, people, I think, are shopping more and more on Temu. So I think it's a no-brainer at the right price. And today it's starting to look a little bit like the right price.
Yeah, this company is definitely still a risk, but like you said, the upside potential is absolutely there for growth investors who are interested in those kinds of big returns. If that's you, check out this free premium report on marketbeat.com right now. It's the next 7 blockbuster stocks for growth investors. These stocks show promise for long-term growth down the road. You can scan the QR code or click the link in the description of this video to get that free report on marketbeat.com right now. All right, let's move on to your next pick. Not as much for growth investors, but right now, this familiar company does have a big upside potential too.
Right, that would be the darling of the United States tech sector, Apple. I think that after the tariffs came in and after everybody thought that iPhones were going to cost $3,000, $5,000 per pop, right? I don't think that that seemed to be based in reality. I don't think that was based on logic, right? Economically, sure. If you increase costs, if you create bottlenecks in supply, costs have to go up. But I mean, an iPhone costing that much, I don't think that was going to be a scenario that was based in high probabilities anyway. So again, President Trump came in, exempted consumer electronics from Chinese exports. And right after that, Apple, I think it had a 7% update to start the week, right? And we were advising to look at this stock as early as last week, once we saw the price crash below the 80% of its 52-week high, which is officially a bear market. Now, if the S&P 500 rebounded off of its own 80% of 52-week highs, then it means that the market isn't ready to sell off yet. And then the leaders have to step in and join that cause. Apple being one of them. And sure as it was analyzed and pointed out, the stock recovered all, if not most of the sell-offs that were driven by the tariff. So I think that the probability of iPhones costing over $3,000 are pretty much out the window at this point. Though it might have taught a lesson to the company to start diversifying their supply chain, which is maybe something they'll want to do moving forward. But as far as the stock price and the company's stability of cash flows and profitability, I don't think there's any red flags out there so far.
Yeah, Apple has already had quite the rebound, but I think the question for investors is there still more rebound left? Is there still ground to be gained? If you're just watching this video today, is there still more room to grow for Apple after some of the losses it's had the last few weeks and months?
I would say the probability is very high that the ceiling is still higher for Apple stock. Why? Because, as we said, the S&P 500 has successfully rejected that bear market territory, right? It first got into correction, then it got into a bear market, and everyone said, we're not ready yet. We think that there's still upside. We're still thinking there's growth in the US economy to be had and to be priced into the S&P. And again, one of the highest components or constituents of the S&P is Apple. It is the darling status of the stock market. Whenever people give up on Apple, there's surely a bear market around the corner, and I don't think people have given up on Apple yet. Now, it still trades at a significant discount to 52-week highs. So I think that following analyst targets that are still bullish, even during the volatility and the uncertainty of tariffs, should also give you a pillar of optimism to lean on, right? Because analysts, they're not always willing to risk their reputation or their careers by backing up a stock that has been subject to such volatility or such uncertainty. So the fact that they still see double-digit upside for Apple, the fact that the 52-week high is still far away, the fact that all of the iPhone increased cost uncertainty is out the way. So is the case for MacBooks and other electronics coming out of China. I think that the path forward for Apple is as clear as ever. And again, why wouldn't you invest in one of the darling stocks of the US market today?
Well, speaking of darlings, let's get to your last pick. And this is a big one, but it's also one that I never thought would go below the $100 mark, like we saw in the last week.
Right. Who would have thought Nvidia was going to lose its crown only to bend over and pick it up again, right? I think that Nvidia is one of the names that are always going to be front and center for the stock market, at least until the AI hype is over. And I think that still has some legs to run, considering everything that is being developed as far as domestic fabs, so the factories that produce the semiconductors that we all need for consumer products and electronics. So I think that Nvidia was the poster child of the uncertainty leaving the market right along with Apple. Because let's be honest, you can't have an Apple without Nvidia. You can't have an Nvidia without an Apple. They both are represented as a big share of each other's revenue and orders coming in and out. So I think that both rebounds are, again, another confirmation that the market is not ready to sell off yet, as the S&P 500, again, it rejected its bear market territory, saying we're not ready to go, and where the market goes, the biggest constituents are going to be headed. So you see the recovery in Nvidia, which is again 100% confirmed by the exemption on Chinese exports of semiconductors, of consumer electronics. So now that demand, consumption, and forecast for where these products are going is more clear, then I think Nvidia earnings are going to be a lot more clear as well. Given that if demand and orders are going to be more predictable and more stable down the line, then the chips that are needed to make them, which come from Nvidia, are also going to see the same benefit. So I think that earnings for Nvidia, revenue for Nvidia is confirmed to go higher based on these uncertainties coming lower. And again, where EPS go, the stock price goes. And I think that the rebound from the lows in Nvidia, again, like you said, we never thought we would see it under $100 a share. And just as quick as it went below it, it's now back above it. And I think that just like Apple, we might see it get closer to the 52-week high, if not make a new ceiling after all.
Some really great points, Gabriel, and good information for investors to consider as they're looking at what to buy as the market is still trying to figure out its way around tariffs and the new freeze. Let us know what you think. Are these buys and these picks too risky for you right now? Or are you still loading up, waiting for that next big surge and return of some of the value in these companies? We'd love to hear your thoughts in the comments. Thanks again for joining us, everyone. And as always, happy investing.